Cryptocurrency volatility can be intimidating, but it also presents opportunities for profit. In this video, we'll explore how to make money from the ups and downs of the cryptocurrency market. Understanding volatility. Volatility in cryptocurrency markets is characterized by rapid and significant changes in price. This phenomenon can be attributed to various factors, including regulatory changes, adoption rates, and market sentiment. Understanding the underlying causes of volatility is vital for successful navigation of the market. Regulatory changes, such as government regulations or legal frameworks, can significantly impact cryptocurrency prices. Adoption rates, including the pace of mainstream acceptance and usage, also influence market dynamics. Additionally, market sentiment, which encompasses investor attitudes and emotions, plays a crucial role in shaping price movements. The consequences of volatility can be far-reaching, resulting in significant price swings. This unpredictability underscores the importance of having a well-thought-out strategy in place to capitalize on these movements. By grasping the underlying factors driving volatility, investors can make informed decisions to maximize their returns. Developing a deep understanding of volatility and its causes is essential for cryptocurrency investors. By staying informed and adapting to shifting market conditions, investors can effectively navigate the dynamic landscape of cryptocurrency markets and make informed decisions to achieve their financial goals. Trading strategies. Day trading is a strategy that involves buying and selling assets within a single trading day. This approach takes advantage of short-term price movements, allowing traders to capitalize on market fluctuations. Day traders typically close out their positions before the market closes, avoiding overnight risks. Swing trading, on the other hand, involves holding assets for a shorter period than position trading. This strategy aims to capture medium-term price movements, often holding assets for a few days or weeks. Swing traders seek to profit from market oscillations, adjusting their positions as trends emerge. Position trading is a long-term strategy that involves holding assets for an extended period. This approach focuses on fundamental analysis, considering factors like market trends, economic conditions, and company performance. Position traders aim to ride out market fluctuations, holding onto their assets until their investment goals are met. Technical analysis and chart reading are indispensable tools for traders, enabling them to make informed decisions. By analyzing trends, patterns, and chart indicators, traders can anticipate potential price movements and adjust their strategies accordingly. This expertise helps traders navigate the markets effectively, maximizing their returns and minimizing losses. Leverage and margin trading. Leverage and margin trading offer traders the opportunity to amplify their gains by using borrowed funds. This strategy allows traders to control larger positions with a small amount of capital, potentially leading to increased profits. However, it's important to note that leverage and margin trading are double-edged swords. While leverage and margin trading can amplify gains, they also increase the risk of significant losses. If the market moves against a trader's position, they may be required to deposit additional funds or sell their assets at a loss. This highlights the importance of understanding the risks involved and using these strategies judiciously. To use leverage and margin trading effectively, traders must implement proper risk management techniques. This includes setting stop-loss orders, limiting position sizes, and monitoring market conditions closely. By managing risk effectively, traders can maximize their potential gains while minimizing potential losses. Leverage and margin trading can be powerful tools for traders, but they require a deep understanding of the risks and benefits. By educating themselves and implementing effective risk management strategies, traders can harness the potential of leverage and margin trading to achieve their financial goals. Options and futures. Options and futures contracts are derivatives that offer traders a way to manage risk or speculate on price movements. These instruments allow traders to hedge against potential losses or gains, providing a level of protection in volatile markets. By locking in prices or rates, traders can reduce uncertainty and minimize potential losses. Options contracts give traders the right, but not the obligation, to buy or sell an underlying asset at a predetermined price. This flexibility makes options attractive for traders seeking to manage risk or speculate on price movements. However, options also come with unique risks, such as time decay and volatility, which can impact their value. Futures contracts, on the other hand, obligate traders to buy or sell an underlying asset at a set price on a specific date. Futures are often used to hedge against potential price movements or to speculate on market trends. Like options, futures come with unique risks, including leverage and liquidity risks, which traders must carefully consider. In conclusion, options and futures contracts can be valuable tools for traders seeking to manage risk or speculate on price movements. However, they require a solid understanding of their mechanics and unique risks. By educating themselves and using these derivatives judiciously, traders can effectively navigate complex markets and achieve their financial goals. Risk management. Managing risk is essential for traders navigating volatile cryptocurrency markets. One key strategy for limiting losses is setting stop-loss orders, which automatically sell an asset when it falls below a certain price. This helps prevent significant losses and protects traders' capital. Another important risk management technique is position sizing, which involves adjusting the size of a trade based on market conditions and personal risk tolerance. By limiting the amount invested in a particular asset, traders can reduce their exposure to potential losses. Diversifying a portfolio is also crucial for managing risk. By spreading investments across various assets, traders can reduce their reliance on any one particular asset, and minimize losses. This strategy helps ensure that if one asset performs poorly, the impact on the overall portfolio is limited. By implementing these effective risk management strategies, traders can navigate the cryptocurrency market with confidence. With a solid risk management plan in place, traders can focus on identifying opportunities and maximizing gains, knowing that they have a safety net in place to protect their capital. This approach allows traders to stay disciplined, calm, and focused, even in the most volatile markets. In conclusion, making money from cryptocurrency volatility requires a solid understanding of the market and various trading strategies. By staying informed, adapting to changing market conditions, and managing risk effectively, traders can thrive in this exciting and dynamic market. At last, don't forget to subscribe our channel.